Hey traders, this is Blake Morrow with Tradersummit, and I have back with us once again Jim Welsh, and we've missed Jim over the last few weeks. He's been traveling, but it's nice to have him on Fridays. We get to get a macro breakdown of the markets and a technical view as well. He loves to mash the technical and macro view together and give us a really great view and almost forecast of the market. So Jim, welcome back to the show.
Well, it's great to be back, and it was good. The last couple of weeks, really not that much took place.
Well, a lot did take place, believe it or not, while you're gone, but price action would suggest otherwise. We have seen a lot of things happen, and this week we had the ECB just yesterday, which thought would move the needle just a little bit more, but we're staying just above parity. There's a lot of moves in the market I'm sure you want to break down. Yeah. But what are your thoughts from kind of looking outsider looking in the last couple of weeks? Have you had any views? I know you stay up with the market, so have you had any thoughts?
Yeah, I think the main thing is that everyone is focused on inflation, and I get that. Obviously, that's been a huge focal point for the Federal Reserve. But I think just like when we were in March and April, people didn't believe the Fed when they said they were going to move expeditiously, from 0.25 Fed funds up to neutral, which was roughly 2.5. And the market sold off pretty strongly, obviously going into June, the mid-June low. And then, 4 or 5 weeks or so ago, this idea that the Fed was going to raise the funds rate and then bring it down early next year really took hold. Because that's what the Fed funds futures was, quote unquote, telling everyone. And Powell obviously threw a lot of cold water on that they're going to raise rates. And as I discussed, really over the 2-3 weeks ago, the Fed policy is hike and hold. So they got to neutral. Now they realize that we need to do more. So they're going to move the funds rate up into where it's modestly maybe restrictive, slightly restrictive in the 3.5-ish range to 4%. And then they're going to hold it there, Blake. And the idea is primarily to avoid the mistakes that took place in the 1970s and slowly but surely slow the economy so that it's under 2% growth and gradually bring inflation down. And the most important point, and this is what we're going to talk about, is the Fed's focus on wage inflation and how that's going to impact monetary policy. And I think that is going to be the next point that the market misses. It missed the move to expeditiously. They missed the hike and hold idea. And I think they're going to overemphasize in the Fed's emphasis on inflation and overlook the labor market. And we're going to talk about that this morning.
All right. Well, let's go ahead and get into it. And let's talk about employment, because as you've pointed out many times, Jim, employment is that last shoe to drop how should we say it's a
lagging indicator.
The lagging indicator. That's it. Yep. It is a Friday, just not only for you, but for me as well. Let's take a look at what you got here as far as your unemployment chart.
Okay, what I've discussed in the last few weeks and in the September macro tides, which I actually sent out August 24th, because I was leaving on the 25th and I wanted to get it out before Powell's speech. What I show here, Blake, is the CPI is as much of a function that's happening now as it is what happened 12 months ago. And what we're going to see between October and March is the reverse base effects. In other words, the numbers from October of 2021, November, December, and then the first 3 months of 2022, as we get into 2023, are going to subtract almost 4.75% from the CPI. Now, that reverse base effect subtraction will be offset to some extent by whatever increase happens in each month during those periods of time. So it obviously, if the CPI month over month starts to rise modestly, it'll subtract from that 4.72%. But my point is, we're going to see a very sharp drop in the CPI. And even if inflation stayed at 0, which it was in July, the CPI would drop to 6.2% by the end of this year. And so my point is that we're going to see inflation come down, I think, relatively hard primarily because of energy. Things like shelter, because of the way they calculate rent, and owner's equivalent rent are lagging. So they're going to continue to lift core inflation. Service inflation is going to continue to push higher modestly as people move away from goods and buy more services. And even though food isn't part of the core inflation, we're going to see in food inflation, I think, also hold up, pretty well, and maybe not really decline all that much. But the point being is investors are so myopically focused on inflation, so that when we get the CPI report out next Tuesday, I believe, it's going to show another decline. And people are immediately going to jump to the conclusion, oh, maybe the Fed won't have to tighten as much. They're going to look at this as being good news. Yes, they are going to look at it as good news. But I think that the Fed's focus, as we're going to talk about in a minute, is going to shift away from, okay, inflation's coming down, but they're looking over the next 2, 3, 4 years. And what happens after we go through this period of slow growth, potentially a recession, during the next expansion. And that's why I think the Fed is focused on the labor market.
Okay, well, you brought up a chart of wages and
Yep.
wage growth. What do you make of this viewpoint here?
Okay, the thing people have to realize is in the 1970s, the Federal Reserve would increase the federal funds rate rather dramatically. And you can see, based on the CPI, the Fed was basically chasing the CPI up and down. But because they increased the Fed funds rate so dramatically in 1969 and 70, obviously 73 and 74, you got a very sharp decline in the economy. Recessions resulted, which then forced the Fed to do a 180-degree pivot and slash rates. So the Fed has looked back at the 1970s, Blake, and concluded that's what we do not want to do. And it's going to shape policy over the next couple of years, I think, significantly. So if we look at where we are, and Powell has talked about this repeatedly, how tight the labor market is, and you can look at that by job postings, how many people are looking for a job, labor differential, which defines are jobs easy to get or hard to get. Yeah. And they're really easy to get, okay? The unemployment rate ticked up to 3.7, but it's near a 50-year low, and wages year over year up 5.2%. So what I discussed in the September macro tides is if you look at history going back to like the 1950s and how much the unemployment rate rose from its low as the Fed was tightening policy to bring inflation down, the average was about 2%. And what that implies, obviously, is the Fed funds rate getting to 5.5% or so. Larry Summers wrote a report, this is probably 6-8 weeks ago, saying that, hey, we're going to need the unemployment rate above 10% for 1 year, 6.5% for 2 years or so to bring inflation down toward the Fed's target. In other words, how much does unemployment rate have to go up to bring inflation down 1%? So that was his conclusion. One of the guys on the Fed board, his name will come to me in a second after we probably moved on, kind of retorted and said, well, we did our analysis, and our analysis says that the unemployment rate might only have to rise to 5% to bring inflation down. So the point I raised in the September macro tides was, are the markets really ready for a 5% or higher unemployment rate? And the answer is no. So again, this chart tells us why the Fed, I think, is going to be raising the funds rate and not jacking it up further, to avoid the risk of tipping the economy into a recession. Okay. So they can hold it up there and slowly, get the economy to ease off, but more importantly, to create enough slack in the labor market, Blake, and this is the key point. From their perspective, they need to create enough slack in the labor market over the next 18 months or so that when the next expansion begins, there's enough slack in the labor market so that wage pressures don't immediately emerge and begin another problem with inflation. That is the lesson they drew from this 1970s experience. And I think that's why they're trying to be very gradual and hold the funds rate there at a high level relative to obviously history here in the last 20 years for an extended period of time. So my point is the markets are going to react to inflation. And that's a misjudgment that they're going to conclude, oh, the Fed's going to be able to ease. No, if I'm right, and the Fed is really looking at the wage component of inflation and the tightness in the labor market, the market's overemphasis on inflation coming down is wrong. And I think we're going to see that play out as we go into later this year. Near term, I think the markets, have been rallying. My expectation, as I wrote earlier this week, was, I think we're going to see a rally here based on a number of things we're going to talk about.
Okay, well, you bring up labor participation next, but I wanted to say, this is where you're looking at the market and you're realizing that rates are going to go higher, but they're going to stay high, and a lot of people are pricing into 2023 in some cases that you might see some cuts, and if that comes and the market starts pricing that, you think that the market might be actually wrong in that assumption.
Absolutely. I mean, again, going back to December of last year, December 9th, after inflation hit a 39-year high, in November, Powell told everybody, yep, we were wrong. Inflation is not going to be transitory. And on December 9th, the Fed funds future was forecasting that there would only be 3 quarter-point increases in all of 2022. So the idea that the markets know anything like that, I think is just stupid. I mean, and yet, even despite that miss last December, people are relying on the Fed funds futures like it's gospel, and then, oh yeah, the Fed funds futures are saying this. And my point, Blake, is just that, unfortunately, I think most of the people who are managing money have been around 25, 30 years, so they have had a lot of experience, but they've never encountered what we're encountering now with inflation and what the Fed feels it needs to do to really bring it down.
You're right. You're right, Jim. And I think this is a good point to bring up that, if you're looking for guidance in this environment, and I've been in the markets now a quarter century, and I haven't seen anything like what we're seeing right now. And you got to really search for people like yourself that have been around and that have seen it. And there are very few advisors out there that have done that. And so I think people should take heed of that warning. You got this chart right here that you wanted to talk about as far as labor participation. What do you make of this chart?
We're going to look at three charts. Okay. So, as I discussed in the September macro tides, there are some longer term factors that potentially will help keep inflation higher than it otherwise would have been. And most people aren't thinking about this stuff, but I think it will play a role potentially as we go out 2-3 years from now. Labor participation. So in the mid 70s, we saw in the first chart, wage growth went nuts. All right. I think in 1979, the year over year, it's either 79 or 76, year over year wage, average hourly earnings were up 9%. I mean, it's like incredible, right? So what happened though, from 1971 to let's say the late 80s, we saw, the overall, which is the top part channel chart, showing labor participation, moving up, nicely. Okay.
Yeah.
But what really drove it was women coming into the labor market. And as you can see, from 43% up to 57% in 89. So my point is, there was this pool of available labor that came into the labor market, which I think helped moderate wage gains and keep them lower than they otherwise would. As we can see in both charts, the labor participation rate for everybody, the top chart, has been declining for 20 years. A lot of that is due, baby boomers retiring and other factors. But my point is, this is a structural problem. Even the women in the labor force has been contracting since 2001. So we don't have a pool of labor that's going to bring and really help the Fed in terms of creating more labor market slack. So this has a potential, if this is a chronic condition, we're going to see upward pressure on wages be maintained, because we're not going to see a new influx of workers. And what it kind of means is that for the Fed to achieve its goal, we may need to see unemployment rate go higher to create that excess slack. So to me, this is one of the things that it argues that inflation, yeah, is going to drop rapidly over the next 6 to 9 months, but it may not then continue to fall going out further. The next chart we're going to look at is energy. So, hey, energy prices have been really problematic the last 18 months. They were also problematic in the mid 1970s. In 1973, oil was $3 a barrel. OPEC embargoed oil sales to the West, the US, of course, and oil went from $3 to $12.74 to $39 in 1979. What happened? There was a huge increase of business investment by oil companies. It went up fivefold. And what that meant then is, wow, we got a lot more supply. Oil prices dropped from $39 to about $10. So these chart, or the top chart there, I think might be adjusted to 2014 dollars. So they took 2014 and went backwards. So some of the prices I'm talking about aren't going to show up on that chart, but that's what happened in the real world. Same thing happened 2010 to 2014. Oil was fluctuating between 85, 110 or so. But fracking hit critical mass, brought a huge increase in supply. Oil prices dropped from 110 to about 45, stayed under 60 until last year. So again, what happened is market forces came to bear. So you had high prices, it attracted investment, and that then increased supply, prices came down. What you can see in the bottom chart is over the last decade, the amount of global investment in oil and gas exploration is down about 50%. So what does that mean going forward? We're not going to see the same level of supply coming on stream as we would have and what we did see in the prior period. So again, what this suggests, yeah, oil prices come down, but they're going to likely hit a level that's a higher plateau than they otherwise would have and did in those two periods from in the 70s going into the 80s, and then obviously in the mid 2010s. So this is another factor that suggests that, we're going to get relief on energy. It just may not be as significant and long lasting as the last two prior episodes of inflation that was contributed to by high energy prices.
So what does globalization have to do with it?
It's another factor of these macro things. So what we saw from 1945 to about 2010 is trade increased globally. And what we saw in the US is after China joined the WTO in 2001, US companies were able to move production to China, which meant far lower labor costs. Then China sent the goods to us, which actually brought import inflation down. Goods inflation was negative for a good part of the last 20 years. And now what we're seeing is globalization is retrenching. And if you look back, back to 1913, obviously World War I, during the 20s didn't really recover. And then in the Depression, we saw another big drop in trade and a huge increase in protectionism. I think global trade dropped by 40% during that period of time. So the point being is that globalization added and contributed to keeping inflation lower than it otherwise would be. Now we're seeing companies move production to other areas where they have higher labor costs, bring some production back to the US. Is that a good thing? Yeah, I think so. But at the same time, it's going to come with a price. So my point here is that central bankers struggled for much of the last 10 years or so getting inflation up. Well, globalization, helped that effort and made it possible for inflation to stay lower. They thought it was all their effort. So my point is, we're seeing a turning of the tide of a number of these macro forces in terms of labor market, energy, globalization, that are going to act collectively to keep inflation at a higher level than what we've seen over the last 20 years. And at some point in time, I think the Fed and other central banks will be forced to, in a sense, accept and tolerate, an inflation rate that's above 2% for a lot longer. But I just think these are the things that one needs to think about. We talked about a month or so ago about I think the coming secular bear market, where the stock market is going to struggle for like 15 years between like 2024, 25, 2040. And so my point being is these are some of the things that start to emerge when you go through a secular bear market. So they were a great tailwind over the last 20 years. And, I think that's obviously changing. So, again, longer term kind of stuff, but, it's important for me. I try to look ahead as much as possible. And the idea of a secular bear market is very significant because most financial advisors and investors use buy and hold.
Yeah.
We've seen a huge increase in the amount of assets using passive investing. Well, what happens in a secular bear market? Initially, people don't believe it. And then when you have a big decline, oh, okay, we're going to rally. And then when you take out that first low is when people start to think, wow, something different is happening. At some point in time, if I'm right, in that secular bear market process, passive investing money, they're going to puke. It's what happens. That's what markets do. And, that will create probably a pretty significant and important low, but that may not be for 10 years.
Yeah.
So anyway, these are all big type of stuff, but I think for me, it's important to try to have that kind of perspective to put what's happening today within that kind of context. It's possible we've already started the secular bear market, given some of the shifts we've seen over the last year.
All right. Well, let's talk about what we do with it now. So what do I do with this information now, Jim?
Yeah. Now. Okay. All right. Now, well,
now.
what I wrote in this week's weekly technical review was that we should expect a rally. The market was obviously very oversold. The bottom part of that chart shows the 21-day net advanced decline oscillator. When it gets below the green line, you're oversold and you're going to get a bounce. In addition, the S&P came down to around 3,900, which is something I wrote about on August 22nd, that I thought it was important that we hold 3,900. Although there was a brief dip below it on Tuesday, we obviously have held and tagged that trend line. And so to me, all this was like, okay, we're going to get a rally. When the CPI comes out next Tuesday, my expectation is that the market should like that and rally in response to it. The idea that Powell has, kind of thrown cold water. And so people realize, wait a second, the Fed really is going to keep rates maybe higher than expected. There's still a cogent number of people who think, yeah, but I think when everything is said and done, they're going to raise rates and then have to bring them down. This week on Tuesday, why the market rallied like it did was Lyle Brannard made a comment that, yeah, at some point in time, the risks are going to become more even. In other words, right now, the risk of inflation and us fighting inflation far outweigh the risk of recession. At some point in time, we're going to keep tightening policy. The economy is going to slow and the risk of recession is going to be equal. That's why the market rallied on Tuesday. So there's still a lot of people who want to believe that the Fed isn't going to do what they're saying they're going to do.
All right. Well, what do you make of the put call ratio then that we're seeing in the S&P?
Well, it's also supportive of the idea of a rally. You can see the 10-day. I use a 10-day exponential of the call put ratio, and it's down to about 106 a couple days ago, which is just about where it was in mid-June. So this just says that sentiment has gotten very negative, and what that also means is positioning has gotten okay, we're expecting a decline. And when you reach an extreme, usually what happens is the market slaps you around a little bit.
Right.
And so the combination of being oversold, sentiment being this negative, to me just said, we're set up for a rally. And then the next chart we'll look at is, well, where could the rally go, to answer your original question of, isn't this all wonderful? Let's put it in perspective. So 4150 to me seemed like kind of a shoo-in. Now, as you can see, I've got some red numbers there, 1, 2, 3, and the low I think is what, 4130? Is that, I can't read that number because I don't have my glasses on for vanity reasons. So that would be, if that was a low of 1, if this rally overlaps that, then it makes this rally more, or the decline, a 3-wave rally. And I think it implies that we have more to bounce. So my assumption here is 4150 is possible just based on the chart. And then secondly, I think still, I've been reasonably accurate about what the Fed was going to do at each of these meetings, even though the market went, like this a lot of times in terms of what the expectations are. So now there's, as of yesterday, 88% chance that the Fed's going to go 75 basis points, and the ECB did it. And I still think there's a pretty good shot that the Fed is going to go 50 basis points, Blake, at the September meeting. Again,
that would be a shock to the system, but sure would help stocks.
The market. Absolutely. Yeah. Absolutely. So I think that's the likely course. And then, if they go 75, the market will, but they're going to do only 50 in November. I mean, personally, I just think the idea of slowing the glide path a little bit on the magnitude of rate increases fits with the overall framework of what the Fed's trying to accomplish. We're raising rates. We went aggressive. Now it's time, now that we're going into above neutral, we need to maybe just back off a little bit so that we achieve a slowing economy without a recession. So that's why I'm there. But obviously, if that proves correct, all of a sudden, I think, could the S&P get back to 4,300 in that scenario? Yeah. So I'm looking for the next rally when that is over. If I'm right about the Fed's focus about wage inflation, labor market tightness, Blake, that's going to set up, I think, another fairly decent decline and a shorting opportunity. We'll deal with that when we get there, but that's how I'm putting what we talked about initially within the framework of what does it tell us today, what we should be doing. Short term, the market, I think, is headed higher. But, in the context of the bigger picture, I think the bear market is not over. That's my conclusion.
You want to look to sell rallies when you see them. How about the dollar? Has the dollar made an important top here? I mean, it sure does feel like it. The euro hasn't complied and spent much time above parity. But the dollar yen, starting to get some intervention, verbal intervention from the Bank of Japan overnight. What do you think about the dollar index here?
Again, as I said, there's a trend line connecting the last couple highs. I can't remember the exact dates on those that come, 111 to 111.50. So 3 weeks ago, I wrote, hey, there's a potential that you could see a spike up to that level. It got to 110.79, I think. Well, that's pretty darn close. Then we had a reversal, I think yesterday or the day before, probably the day before. So I'm looking for a top in the dollar index. It's just a question of what pieces are going to come into play. Obviously, if the Fed goes, okay, you get a good CPI report, and market starts to think, oh, the Fed won't raise rates as much. And if the Fed does 50 basis points, that's the kind of tailwind for the euro that the euro needs and headwind for the dollar to bring it down. So I think we're approaching an important top in the dollar index. And it will take time because Europe still has so many problems with energy. They're definitely going to have a recession, but it dropped towards the 105 area, 104. To me, just seems like it's going to happen. It's just going to maybe take a little while to unfold. But obviously, as people shift and start to think that the Fed is going to back away, that should be negative for the dollar.
Well, this should be good for gold, I would think. So you got a chart of gold. What do you do here?
Okay. So, as anybody who's been paying attention here and listening to us, my expectation was, buy gold near the 1700 level, back in mid-July, rally up to 1800. At 1800, I said, okay, I think we're going to have a pullback that retraces 50% of the $124 rally, which would have been around 1750. The 618 retracing was 1730. That's what I thought was going to happen. And then another $124 rally that would get to the objective that we had talked about, 1850. So this pullback was deeper than I thought, but I still think that 5 up from where the C is, which completed, I think, a correction from when was that, August 2020. That 5 up is a wave A as opposed to a 1, and that this pullback is a B. And we are going to see gold rally in the next handful of weeks. up towards the 1805, which was the high we saw in August, to maybe 1815. Could it get towards 18? Of course it could. If the dollar weakens enough, if I'm right about the Fed doing 50 instead of 75, gold could make a move up towards that 1850, 75. But I think the high probability trade is that gold will rally up to the $1,800 to $1,815 range in the next 2 to 4 weeks. So it'll come and it'll come quick.
So so here you got bonds and you're looking at the TLT. The bond market's been under pressure, yields have been higher. So I mean, everything that you're saying, since it seems like we're in just a correlated market at the moment, yields are going to start coming down. So I would assume you think the TLT is going to start to bounce here.
Yes, I'm looking for a low. I'm not sure the pieces are in place quite yet with TLT. As you can see on that chart, mid-June, I suggested buying TLT around 110.25, sold August 2nd, because I thought, you got 3 waves up, choppy rally. We're going to have at least a decent sized pullback. And there's also the risk, although at that point, I didn't think it was the most likely outcome, of a new low, because potentially the bottom in mid-June, instead of being wave 5 from the 155 high last December, was only wave 3. So now we've made the new low. And now it's a question, and I think we are ending the decline that began last December from 155 and TLT. So it's just a question of, to me, buying TLT, 106 or so. In other words, there may be one more drop here coming on TLT, but I'm looking to be a buyer because I think, bonds are setting up for a decent sized rally. And at a minimum, the target would be wave 4 of lesser degree, which is up near 120. So,
all right. Well, Jim, I mean, as bearish as you are in our secular bear market potential, it seems like in the near term, at least somewhat constructive. So that makes me feel a little bit better that we might live to see a few more weeks at least before all hell breaks loose.
Could be another year. Blake, I mean, I still think there's the potential that we will see one more new all-time high in the S&P before the secular bear market begins. In other words, at some point in time next year, the Fed is going to shift. That's my take. I think in the near term, next 6 months, 8, 9 months, they've got to, kind of stick to the game plan. But global events and so forth, what's happening with Europe, in China and so forth, I just think, at some point in time, the Fed is going to be forced to switch, not so much because of what's going on maybe in the US, but globally. And when that happens, that opens the door, I think, for another new all-time high in the S&P. So, I try to keep my head on a swivel and not get married to one scenario or another and watch the tea leaves in front. And what the tea leaves have said over the last week is there's a low, we're going to see a rally. And then it's a question of how high is it going to go? And, we've discussed, I think there's a tailwind coming from the CPI and potentially even the Federal Reserve.
Well, Jim, I want to say it's nice having you back. It's nice having your guidance. And if you guys and gals like what Jim does, make sure you give him a thumbs up and welcome him back. Jump in the comments down below. If you have any comments specifically for what Jim's covering, or maybe some of his outlooks, he can jump in the comments too and address some of those questions for you. And Jim, if I'm listening to you for the very first time, how do I find out more about what you do at Macro Tides?
MacroTides.com. You can find more about becoming a subscriber, and then at Jim Welsh Macro on Twitter, as I do, little snippets of ideas and so forth. You can kind of follow that as well.
All right, and if I want to get your most recent Macro Tides, I could just email you, right? At what's your email?
Jim Welsh Macro at Gmail. And I'm glad you mentioned that. I think that September letter is something that, Blake, I'm going to be referring to, over the next 6 to 12 months. I thought that, I felt really good about that letter, particularly because of the longer term view it presented.
All right, Jim. Well, I want to say, like I said, it is nice to have you back. I look forward to our meetup next week, and have a great weekend.
You do the same, Blake. Thank you so much.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like
share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.